Hi everyone, been invited here today to speak on the topic of investor returns versus investment returns. Investors, in my opinion, especially in a country like India where equity investing is still at a nascent stage, have not yet understood what equity investing is all about. Most investors that have entered the market, especially recently in the last 18 months to maybe 24 months, especially after the strike of the pandemic, are not really investors by nature, so to speak. I think they've entered with their hard-earned money. Most of the investors are going to lose a lot going forward because they haven't really entered with the right criteria or right agenda, even though they call themselves investors. Investing is a discipline. I'm not a big fan of the saying that investing is an art. I don't really see much art in it. It's a lot of luck and a lot of patience, which I don't think the new age investors have in them yet. So it's going to be a hard learning curve. As you've seen, the last 40 years data shows us that the S&P 500, the overall return of the S&P 500 in comparison to an investor return in the US itself is less than half. In India, if you look at those numbers, they're far more staggering and far more shocking. I think the average investor returns over the last 15-20 years on an average has been about closer to 2%, which probably hasn't even beaten inflation over long periods of time. And the index or mutual fund, the industry overall, a good average equity returns has been over 16 to 18% last 15 to 20 years, say. So there's been massive underperformance overall in investor returns, and you can absolutely attribute that to behavior, nothing else but behavior, which is interesting because investing is the only business, investing is the only thing you do where you don't need to know a lot or you don't need to have a huge knowledge base, you don't need to be a specialist. In fact, it actually may go against you. The age-old adage, which basically goes as less is more, could not be more apt in investing as a discipline. As I mentioned earlier, that investing is a discipline, not an art. Contrary to popular belief, the winners in this game in the long run are the ones who stay patient the longest. So as the greatest investor of our generation, Mr. Warren Buffett has aptly put, all you have to be is above average for a really long period of time. You don't need to do anything spectacular. All you need to have is patience. And unfortunately, patience in this case is the rarest commodity. We've seen over the years that investor returns usually significantly underperform investment returns, especially in the long run. S&P data over the last 40 years shows us that investor returns have been half or less than half of the S&P 500 index over the last 40 years, which is quite incredible because all you kind of had to do was buy the index and sit patiently. Unfortunately, patience is the rarest commodity of them all, which is why I make my point that investing is a discipline, not an art, contrary to popular belief. I want to touch upon a subject which I feel is critical to the overall subject that I'm speaking about today, which is the behavior gap. I would like to bring to attention the overall thought process between linear and exponential thinking. Most individuals think in a linear fashion. It's easy to do, it's easy to understand, it's easy to digest. What's required in investing and investment behavior is exponential thinking. The ability to think compounded. Because if you can't think compounded, your returns won't compound. Because you won't have the correct behavior to appropriate the returns. On this topic, which is why you have very few investors that you read or hear about. The few of the legends in the world in the form of Peter Lynch, Warren Buffett, Terry Smith. I mean, I could name 100. But obviously you get the point. So what happens in this situation is we read about them, we know exactly what they do, we know exactly how they behave, yet there's only a few of them that we read or hear about. Which basically goes back to my point that linear thinking goes against investment behavior, which again goes back to my original point that investing is a discipline, not an art. Exponential thinking is what we need to adopt, what we need to adapt towards in order to be a successful investor. How do we do this? Rule number one, the rarest commodity of them all, patience. Probably the hardest thing to do. The greatest thing to do in investing is to do nothing at all. It's said by Terry Smith, probably one of the greatest fund managers of all time, or Fund Smith Equity. The ability to do nothing is again a discipline. The ability to think exponential, ironically enough, requires linear behavior. It's counterintuitive in nature. It's an oxymoron, so to speak. So linear behavior, consistent behavior for long periods of time leads to exponential thinking and exponential returns from an investment point of view, even a self-growth point of view for that matter. So I would like to add a point here. Why I keep saying investment or investing is a discipline rather than a skill or an art, because it's the only thing you can do where you don't need to be or have immense amount of knowledge to actually be successful. I can't all of a sudden become a heart surgeon, right? I can't just not be a trained doctor and all of a sudden become the greatest heart surgeon of all time. But I could become a very, very successful investor by doing nothing at all. I can't play like Virat Kohli if I don't have the ability to have the propensity to train like him, practice like him, right? There's an element of skill, there's an element of talent which has to be attributed to the man. There's an element of a different kind of discipline. It's the consistency in behavior again, but to hone his skill, right? So you need to start on ground 5, unlike ground 0 when it comes to investing. You can't just become a specialist as something out of the blue. Fortunately, investing allows you that opportunity. There are so many success stories across the globe that we hear of where people basically ended up with millions of dollars because they did nothing. The art of investing all boils down to discipline. Therefore, it's not an art. I keep on repeating this. I cannot emphasize enough on this point. Usually people think that there's some skill attached to it. Of course, there is a skill attached to it. There's a lot of skill attached to it. The ability to understand what you want to do and how you analyze companies at the end of the day or fund managers at the end of the day requires some amount of skill. But a lot has to be attributed to luck as well. If we don't attribute our success as investors to luck, we're basically defeating the purpose. The greatest risk in investing or in life or in any business is starting to believe your own luck and not attributing it to luck. Luck plays a very, very significant role. As sad as it may sound, the greatest stories of them all will teach you that it has a lot to do with luck. Luck is a big factor in the overall scheme of things, and you make your own luck. And basically your luck comes with discipline and patience. So there is a way to get there, there is a way to get lucky. The 60-70% of luck that you attribute to your overall returns, your overall living, your overall exponential thinking and the ability to grow as an investor is actually a game of patience. So you can make your own luck. So when I say luck, I don't mean you're tossing a coin up in the air and you're hoping for heads or tails. You are being able to achieve that luck, earn that luck with your patience. You need to put literal time into this game. Of course, all that being said, there are 500 ways to heaven. You have to be yourself. You have to learn who you are first. You can't imitate XYZ person and expect the same results, because everyone has their own way of going about things, their own ability to take risks, their own ability to think through things, their own conclusions that each investor arrives at. It can be significantly different even if you arrive at the same conclusion as to how it affects you and how you react to it. Why I keep on harping on patience every time I speak to you guys is it's a game of tail events. 1% of your entire investing journey will pretty much dictate the remaining 99%. And the only way you're going to be able to hit that 1% is by having or creating or developing the ability to do nothing at all. And I'm saying this strictly from an investor point of view. Of course, you have momentum investors, traders, you have day traders, scalpers, people doing well in derivatives. There are, again, 500 ways to heaven. But I've been invited specifically to speak about investor behavior. Therefore, I'm going to just speak about long-term investment and long-term investor behavior. So moving on, another topic I would want to add on to this discussion would be context. Probably the single most key element in the grand scheme of things when investing, in our investing career, in our investing lives. Everything at the end of the day is context. If we look at the world, the chain of events, history, and what history has taught us. So let me give you an example. Let's put ourselves in a position, right? Imagine a 21-year-old kid in 1945 in Germany, in the same year, in 1945, another 21-year-old kid in the United States of America. Who do you think would have a higher ability to take risk? Who do you think would be more secure with their surroundings and their foreseeable future? I'm sure the 21-year-old kid in Germany post World War II won't be thinking of investing in stocks. I mean, that would be irrational, right? Although it would be the right thing to do. I mean, if you would want to buy equity at the greatest time of all, it would probably be 1945 Germany. But as I said, investing is counterintuitive. People don't tend to think against the tide. Most of the people who usually think against the tide are usually winners, as long as they believe in the concept of luck playing a role. The moment you start believing your own hype is when you go downhill. The ability to adapt, the ability to think through things, to think through context, to think through errors is what makes an investor successful or excellent, so to speak. Success kind of chases that. So let's take Mr. Buffett for example. His greatest return in US dollar terms, not percentage wise, has been on one stock which he 8-10 years ago wouldn't have dreamt of buying, which as on date happens to be his largest holding in his overall portfolio. Apple is his single largest earner in US dollar terms in his portfolio of all time. Who would have thought that 15 years ago, a decade ago, that a Berkshire portfolio would have an Apple as a holding? So the ability to grow, to evolve, to adapt, to understand change is the greatest example of them all. The ability to attribute your returns significantly to luck, and the ability to know that, okay, X doesn't work, Y does, even if it goes against the core belief of your overall principles, is probably the greatest key ingredient to become a successful investor. So let's take an example in the form of Benjamin Graham, the author of Intelligent Investor, the original guru of Mr. Warren Buffett. As we all know, I mean, every investor globally has started investing by reading The Intelligent Investor. Now, as we know, Intelligent Investor had, I think, 6 editions of it over the years. And every edition going forward had an evolution in the formulas. What applied in the 20s probably didn't apply in the 30s, evolved in the 40s, evolved in the 50s. So every edition additionally added had a different formula. The formula was in line with context of their surroundings, of where they were and what would work in that time period, in that context. The ability to adapt in that situation is the key ingredient in order to be a successful investor. In fact, towards the end, Mr. Benjamin Graham was asked a question that would his style of investing on the back of his formulas, on the back of his studies apply? And he was actually very candid in saying that it wouldn't apply anymore. There's a new growth, there's a new way of thinking. The context is completely different, the surroundings are completely different, the age is completely different. So the evolution of thought, the ability to think exponential, the ability to adapt in a scenario, and the ability to attribute your success, a large chunk of it, to luck, plays a key role in having grown as an investor, which was shown by these legends. To give you an example, I would like to use Sir Alex Ferguson, the greatest manager of all time, in my opinion, the erstwhile manager of Manchester United, who literally ruled the roost for a good part of 24 years at probably the greatest club of them all. His 24 years in charge of Manchester United evolved into 6 different teams over the years. The ability to adapt to the situation at hand, to the context which he was given over and over again, is what allowed him to be a successful manager for 24 years at Manchester United. A lot of managers came and went in that period who were very successful for briefer periods of time. But he's the one who had the ability to adapt, to understand what was required in that moment and what wouldn't work that worked in the past. The ability or the gratitude to attribute luck as a key factor in his growth, and the patience to understand that, played a key ingredient, a key role in making Manchester United what it was in his 24 years. You had the likes of Jose Mourinho take over in 2004 in Chelsea, had a brief 3-4 year span where he was highly successful. It didn't last 24 years. You had Arsene Wenger, who was great for a slightly longer period of time. So you had football managers in the English Premier League who've shown signs, but no one did it for as long as Sir Alex did it. And you must realize that he took over in the late 80s and he retired in 2013. So there was like almost 3 decades of evolving as a person himself. He understood what was required when he first came in. He understood what was required over the next 5 to 10 years. And that evolved. What he did in the first 10 years would not have worked in the following 10 years and in the subsequent 5. He built 6 teams over that period, and all 6 were highly successful, time after time after time. So here we have an individual who understood context, who attributed his success to luck, who showcased gratitude towards it, and had the ability to evolve, had the ability to realize when he was not right in context. I couldn't give you a more better example than Sir Alex, honestly, very close to my heart as well. I would like to speak a little more on security and the ability to take risk. So let's look at us in our family history. A couple of generations ago, in our grandfather's era, most people in that era probably worked for job security, which is why you saw them working in a single company for their entire lives and then living off that pension which they earned with a lot of hard work and labor. In the following generation, you would see people already a little secure with the job security angle because of the previous generation that had already laid down the platform for them to grow. In that situation, the focus is more on standard of living. Standard of living became the new context, became the new norm, became the new area to grow into. In our generation, we live more for quality of life, quality of living, more discretionary in nature. The ability to have the context which we are surrounded by, the ability to choose the quality of life we wish to lead today was laid on the back of our previous generations. From the job security angle and from the standard of living angle. Every generation has allowed a platform for the next to grow on. So again, context plays a big role. And the decision-making ability then, the risk-taking ability then will obviously and naturally be much higher for us than it was for 2 generations ago or a generation ago. So it's very important to understand again from a context point of view. When you're speaking to someone, probably a generation or 2 elder to you, it's very important to understand the surroundings they have witnessed in their life, the context they are coming from. Have they adapted enough or not? It's very easy for us in our generation to showcase our conviction levels, but for a generation ago to understand that it really doesn't come naturally to them. It's again context. So as I say that you have to adapt, you have to learn. So it is our responsibility of this generation to educate the previous generation just the way they have laid the foundation for our future security and growth. Everything that we are today, we must attribute to the previous generations. They've allowed us this platform. But again, we must take it upon ourselves to help them bring into the context of where we are today so that the future generations can continue to grow at a faster rate. Moving on, since we've spoken on context, security, risk-taking ability, I would also like to now bring into this entire equation the concept of happiness. At the end of the day, we're investing. What are we investing for? I'm not a big fan of goal-based investing. I mean, everyone has their own version of it. I'm a fan of investing for the future. So the happiness quotient has to come into play. When you do start investing, you must realize what your goalpost is, where the goalpost is. If you don't realize where your end goalpost is, you're probably not going to be happy. Because as you grow, the goalpost keeps shifting slightly out of reach. Right? So at the end of the day, you must enjoy the journey. If you don't enjoy the journey, it's really not worth it. So the happiness quotient is very, very important. Now that we've spoken about security, risk-taking ability, context, different eras, thought processes, what goes in behind making decisions, history, we must also focus on happiness. Happiness, according to me, is the end game, right? We're investing for happiness, but happiness is not a result. Happiness itself is a process. If you're not happy doing what you're doing, then you probably should tweak it a bit in your favor. End of the day, we need to be happy in the process, because happiness is not a wall that you're going to hit at the end of the road. It's something you have to enjoy. It's life around you. You have people around you. You're not living alone in a secluded, I hope not. Emotions play a key role. Happiness is an emotion, but end game is happiness as well. When I say emotions play a key role, when we're investing or investor behavior, we must keep our emotions in check. We must be a little more clinical in nature. Emotions are best kept for family, friends, gratitude. When you're investing, it should be a little more clinical. If you get emotional with your investments and clinical at home, that doesn't work. It's the most lethal combination that you want to avoid. Should be the other way around. Just like linear thinking and exponential thinking. Exponential thinking is what you need to achieve, but to get to that, you must have the ability to think linear. Life is ironic, pretty much an oxymoron. So is investing, and so is investment behavior. So to continue on that point, I wanted to bring in the happiness quotient the ability to not shift the goalpost, to know what the end game is. The reason I'm saying this is because it's not a rat race. You're not competing. If your friend or your family member is earning a higher return, that's great for them. You need to know what you need to get, and you need to know what you need to get there. It's very important. You need to have your framework ready, and you need to live in that framework. Be disciplined, enjoy the journey, enjoy the process. The only person you are competing against, for all practical purposes, is the person looking back at you in the mirror. So as long as you keep that, as long as you're mindful of that, you're good to go. But the whole concept of competing against yourself again is a process. It needs constant reminding. As long as you are aware and as long as you're constantly reminded of that, you're good to go. Once again, that's a process itself. It's very easy to forget. It's very easy to get enamored by things happening around you at a faster pace. But speed is not necessarily consistency. What wins the race is consistency. What wins the race is consistency. What wins the race is consistency. We all know the story of the hare and the tortoise. It was taught to us at a very, very young age, probably in Montessori or maybe in kindergarten. And it's probably one of the most important lessons taught to us, that to get from one point to the other, you don't need to get there quick. You need to get there right. Doing right and enjoying the process is far more important than getting there quick and not knowing what to do. So on that note, let's move on to my next topic of discussion, which is basically getting wealthy and staying wealthy. Two very different things. Again, an issue that people think getting wealthy is the same as staying wealthy. Two very different behavior traits. People who get wealthy and people who stay wealthy are two very, very different people in general. Again, exponential thinking probably gets you wealthy, and you break it down into linear thinking, and that's when the entire small little bubble bursts. So to give you an example, you must have heard of a lot of stories of people winning the lottery, right? And probably ending up bankrupt within a year. Why do you think that is? A person, the average Joe, wins the lottery, wins a couple of crores here or there. He's probably bankrupt within 6 months or a year. What would you attribute that to? It's just behavior, right? It all boils down to behavior. End of the day, you can get rich, you can get wealthy. The ability to stay wealthy is far more important. The ability to eliminate how many zeros are added to your name and do exactly what works in context of where you are today is far more important. I go back to my previous point of being clinical in this decision making. If you change your decision making in this regard, you're basically becoming emotional. You're taking emotional calls. And for all practical purposes, it will hurt, because it's very rare that emotional calls go right. If they do go right, please don't think that's anything skillful you managed to pull off. Attribute it to luck. Move on. Let's move on to a separate point, a point we must make peace with to begin with. How do we attain this sort of behavior, the appropriate behavior to become a successful investor? Rule number 1, rule number 2, rule number 3. Be yourself, be yourself, be yourself. Know who you are. Learn about yourself. Decisions under distress, under duress will teach you things about yourself. Don't shy away from them. Respect those decisions you make, mistakes as it may be. Make small mistakes, learn from them. If you do end up messing up in the journey, respond to it, learn from it. It is your fault, you did make a mistake. Get on with it, learn from it. Don't get super bogged down by it. That's not going to solve anyone's purpose. The greatest time was yesterday. The next best time is today. So if you did make a mistake yesterday, have the ability to learn from it and move on. You learn more from your mistakes than your successes. I mean, that's a given. We all know that. But the ability to learn from your success as well is a key attribute that you could add. The ability to attribute luck to your success would be step 1 in being able to learn from your success. People who have the ability to learn from their successes, of course you learn from your mistakes, but people who have the ability to learn from their success are the ones who end up reaching the top 1%. And I go back to my example of Warren Buffett owning Apple stock, 40% of his portfolio today. a decade ago, he wouldn't have even considered it. So it's a glaring example of a man almost pushing 100, having the ability to learn from his mistakes, to learn from his success, to not get ego in the way, and to execute a decision which is, in US dollar terms, the greatest decision he's made in his entire life. Money is debt. Use it for assets, not liabilities. I cannot stress on this point enough. People tend to think money is money. Money is debt. It's printed. It's printed against something. It's given to you in the form of debt, whichever way you get it. What you do with it is what creates. So you have the option to create an asset, or you have the option to dig a hole and increase your liabilities. Create an asset, build assets over long periods of time, and have the ability in the future to then maybe splurge a little bit on liabilities that you enjoy, like a nice watch, nice cars, nice houses, nice trips, maybe a private jet, who knows, right? But you got to start from ground zero and build it up. It's not something that just comes to you on day one. You got to build it, you got to earn it. If you don't earn it, it's going to be a problem because you won't value it or respect it enough. And that, again, is an issue. Lack of behavior in success itself is an issue. So we need to have the ability to clinically think through things and execute time and time again. Another interesting attribute that I would want to bring to light is pessimism, paranoia. The greatest attribute any individual could have, any businessman could have, any entrepreneur could have is paranoia. It's the one key ingredient I look for in any businessman or entrepreneur that I talk to. If you don't see pessimism and paranoia in the thought-making process, in the eyes of your entrepreneur or the businessman you're dealing with, that's the biggest red flag for me, personally speaking. Look at Mike Moritz, the head of Sequoia, probably the greatest venture capital fund to ever exist. 40 years in existence, consistently outperformed year after year. How did that happen? Mike Moritz was once asked, how are you successful for such long periods of time? And the response he gave was pretty eye-opening for me personally. He said, the fear of going out of business. Imagine the head of Sequoia talking about the fear of going out of business. We can't fathom it. So couldn't Kodak. That went out of business. Interestingly, the ability to be paranoid at any given point at the time of executing or taking a decision is probably the single most key ingredient that could help your behavior evolve from context to context. That gap is filled by paranoia. The ability to learn comes from being paranoid. The ability to learn comes from being pessimistic. Now, please don't get me wrong. When I say be pessimistic, what I mean is, and let me elaborate a little, a decision that's made or executed should have hope or come with the hope of resulting in great things. But do not discount the worst case scenarios. As the great Mike Tyson said, the only punch that knocks you out is the one that you don't see coming. Today, if you ask me what's the greatest risk number one, I couldn't tell you because I wouldn't see it coming. So the ability to take into account worst case scenarios or to look into the worst case scenarios of every executed decision is paramount for an entrepreneur or businessman to be successful, because that automatically brings in context, that automatically brings in a correct and appropriate behavior, because a decision taken without understanding the worst case scenario is, in my eyes, as reckless as could be. Therefore, pessimism, paranoia, the number one key ingredient you want to see in a business, in a businessman, in an entrepreneur, or in anyone for that matter, in anyone who has the ability or a situation or a position to take decisions. What you can and cannot control, very, very important point. The ability to focus on what you can control. It's hard, it's difficult, it's cumbersome, because what you can control usually yields results in the long run. And what you can't control usually yields results in the short run. So it's very important to make that distinction. To fret about things that you cannot control brings emotions into play, when it comes to decision making. Therefore, to separate what you can and cannot control and to live in the box of what you can control is all you need to do. Easier said than done, of course, but it's a behavior you need to develop. It's a behavioral trait you need to develop and constantly evolve. Without the constant evolution, context changes, you get wiped out. So let's take an Indian equity market example. There's a constant debate between price to earnings multiples being high for certain companies, right? Now, if you take that out of context and isolate it, you look at it in an isolated fashion, of course, things could look expensive or cheap depending on who you are. If you don't attribute it to what interest rates were 10 years ago, to what interest rates are today, then things will look expensive because linear thinking limits us. Exponential thinking, exponential thought process is required for the ability to evolve yourself in the current context, in the current climate. So, what your thought process was 10, 15, 20 years ago in terms of understanding certain ratios or certain numbers and simply copy pasting them into today's context will probably leave you a very, very sad soul. So context matters again. So does pessimism and paranoia. All of these things result in evolutionary behavior, exponential thinking, and the ability to take appropriate decisions. Let me add another example to this point. If I have to make a decision on whether I leave my house on the back of whether it's going to rain or not, it's not going to solve any purpose. If it's going to rain, I should be prepared for it. A raincoat maybe, an umbrella, possibly, gumboots, if you enjoy that kind of thing. What's important to understand at this point is, I can't sit at home thinking that it may rain. I have to be prepared for it. I have to get on with it. So do you. We must all. It's better to be prepared. We can't control the weather, but we can control how we prepare for it. That's the point I'm trying to make. Look at facts. Very key element. Noise surrounds us. TV, media, certain apps that tell us stock price movements on a day-to-day basis, on a minute-to-minute, second-to-second basis. These things are noise in the grand scheme of things. If you're a true investor, it really shouldn't matter to you what the index is at or who's doing what. What should matter to you is if your investee business is growing and doing the right things. Such is the case in life too. If you have an end game, we need to get there. It's not going to get you there tomorrow. As the great Peter Lynch said, please don't water the weeds and cut the flowers. Should be the other way around. Water the flowers, cut the weeds. Weeds grow quicker, we get that. Therefore, there's more excitement when it comes to weeds, not realizing that it's actually weeds. Water the flowers, cut the weeds, not the other way around. Very, very important point. Takes time, takes patience, but it is what it is. And that's what we need to focus on. Looking at facts again is a very difficult thing to do, especially in today's climate. We have information overload surrounding us. There's always someone in our ear. There's always something happening around us. There's always excitement around the new hot topic, where everyone has FOMO. We need to have JOMO, the joy of missing out. The greatest attribute you can have in 2021, enjoy missing out on the new fad. It will do you good in the long run. You'll miss the weeds, you'll water your flowers. Let's move on to the most important topic of them all. What's the ultimate goal? What are we looking to achieve? Happiness? Of course. In my opinion, the goal we're trying to achieve is the ability to control our time, to do what we want, when we want, how we want, where we want. That's the ultimate goal. Everything else is a process to be able to control our time. I've made this point before. Return on time is the most precious of them all. Not return on equity, not return on capital employed, not free cash flow generation, not price to earnings multiple, none of that. Return on time. You should know and value your time. Return on time is pretty much the bedrock of why we do what we do. The ability to control our time is why we do what we do. If we're doing anything else for any other reason, we should reevaluate our situation, our context, our current environment. The happiness quotient. Going back to a previous point I made, the price you pay should be worth it. It should not come at a cost of your sanity, of your happiness, of your mental well-being. 3 very key ingredients for you to have a happy and successful life. Gratitude plays a key role. The ability to celebrate small victories is a key element in the grand scheme of things. Everything compounds. If you have positive thoughts, positive feedback, or if you have negative thoughts, negative feedback, all of these things compound. So the ability to celebrate small victories compounds in the grand scheme of things, just like your investments do. So it's very important to keep that in mind, to celebrate small successes and keep that compounding going. That engine should never stop. And last but not the least, I would just like to make one final point, I think, which is a critical element to our overall decision making. Utopia doesn't exist. However sad that may sound, utopia really doesn't exist. We as investors cannot get in at the bottom and get out at the top. It just doesn't happen. What we can do instead is buy pieces of good businesses and sit on them for long periods of time, letting them grow, letting them compound, letting them achieve what their true objective is. In life too, let good thoughts manifest, let good beliefs manifest, let gratitude play a role. It's best to not get bogged down with the noise that surrounds us. The ability to cancel the noise around us would be probably a top 3 attribute that you can create or possess. Utopia doesn't exist. You cannot get in at the bottom and get out of the top. That won't happen. You might get lucky once or twice, but that's about it. And the failure to then attribute that to luck will be the greatest disaster that will eventually hit your way. So with that, I would like to conclude today. I would like to thank Investor Accelerator Summit. I would like to thank the great group that is DIA, Utkarsh, Vivek and the team for having me and allowing me to express my thoughts and beliefs on what I see is investor behavior versus investment behavior and how to fulfill the behavioral gap in investing and in life. Thank you so much.